In this video, we're going to continue with the example of the statement of cash flows. If you've forgotten, please pause the video and reread the question. Earlier, we've completed the operating activities section and the investing activities section. Now we're going to move on to the third section, which is cash flows from financing activities. Financing activities relate to long-term liabilities section of your balance sheet. So here's your liabilities. Long-term liabilities are notes payable and bonds payable, and then the equity section of your balance sheet. We start by putting the header, cash flows from financing activities, and then we'll start with the long-term liabilities. Let's look at notes payable. Did notes payable change? Yes, it did. We should be able to find something in the additional information section relating to this note. If you go through all of this, Part E says the company paid $2,000 of its notes payable. If the company paid $2,000, that means cash went out of the company, so it is a cash outflow. We're going to say payment of note, and then we're going to put that $2,000 as a negative number to show that cash went out of the company. The next long-term liability is bonds payable. Did bonds payable change? Yes, it did. There was $10,000 worth of bonds in 2020, but there was nothing in 2021. Let's look at the note. Note D says the bonds matured and the company paid back the bondholders $10,000 cash. Bonds payable are liabilities, which are debts of the company, and if the company paid that debt off, money went out of the company. So we're going to say payment of bonds, negative $10,000. It's a cash outflow. We're done with the liabilities section, but we also have to go through equity because both long-term liabilities and equity are sources of financing for the company. Let's first look at common stock. We're going to have to analyze each of these items to make sure if anything changed that there is some accompanying note for that. Common stock did not change, so there was no change in common stock. We skip over that. Paid in capital in excess of par, you know that that's tied to common stock. That did not change either, so we are going to go past that. Retained earnings. Now let's look at retained earnings. You know that retained earnings in the balance sheet are obtained from the statement of owner's equity, but basically what the retained earnings account does is it looks at the beginning balance of retained earnings. If there was any net income, it adds net income. Then it subtracts any dividends paid to come up with ending retained earnings. So retained earnings change accounts for two things, net income and dividends. So we should go check if there was any dividends paid during the year. If you look at note F, it says the company paid $3,000 in dividends. If the company paid $3,000 in dividends, we need to list that as a financing activity. So we're going to say payment of dividends, and when dividends are paid, money goes out of the company. We're going to say negative $3,000. So we're done with retained earnings. Now let's look at treasury stock. Treasury stock did not change, therefore we don't need to worry about any inflows and outflows of cash relating to treasury stock. That takes care of the equity section. So now we are done with cash flows from financing activities. In this case, everything was outflows, so I'm going to say this is net cash used by financing activities. In the previous two cases, it was money coming in or net inflow, so we called it cash provided by operating activities or cash provided by investing activities. But here it's going to be net cash used by financing activities. Let's get a total. And the total of net cash used by financing activities is a negative $15,000. The next step is to add the three sections. So we're going to add net cash provided by operating activities, net cash provided by investing activities, and net cash used by financing activities. The total of these three activities is going to be labeled as either a net increase in cash or a net decrease in cash. In this case, we're going to have a net increase in cash because the number is going to be positive when I add these three together. When I say add, of course, you know that I add these two numbers and subtract the 15,000. Your total is going to be 25,900. So what does this 25,900 increase in cash signify? 25,900 is the amount the company's cash increased during the year. How did it increase? Well, of that 25,900, 12,100 was provided by operating activities, which is what they do day to day. 28,800 was provided by investing activities, which is from buying and selling long-term assets. 15,000 was used by financing activities for paying back long-term liabilities or in paying dividends to common stockholders. And then that resulted in a net change of 25,900 during the year. We're not done yet. Our ultimate end goal is to figure out what the ending balance of cash was at the year end, December 31st of 2021. So we have the change for the year. To the change, we add the beginning balance of cash. The beginning balance of cash is how much this company had on January 1st of 2021. The cash on January 1st, 2021 is the same amount of cash the company ended 2020 with. So what is the cash balance on December 31st, 2021? We know that it is 7,500 because they provided that in the question. That would be the beginning cash balance. Whatever the company ended 2020, that's what they would have begun 2021 with. So we're going to put 7,500 as the beginning cash balance. Now we can determine what the year-end cash balance was for this company. We know that they had 7,500 in the beginning. During the year, the cash balance increased by 25,900. So at the end of the year, the company should have had $33,400 of cash. Let me go ahead and format this so that it's showing as a total. 33,400, that is the last item in your statement of cash flows. Now, how do I know whether I did this correctly or whether I made a mistake? Well, we already know that the statement of cash flows is related to another financial statement. All the financial statements are interrelated. The ending cash balance on December 31st, 2021 should also be listed in your balance sheet. Here's your balance sheet under assets, and it shows that the cash on December 31st, 2021 is $33,400, which is the same balance that we calculated in the statement of cash flows. So when you're working through your homework problems, if you get the answer to match the amount of cash in your balance sheet, then you have done your statement of cash flows correctly. Also, I don't know if you recall when we were doing the operating activity section and looking at the change in current assets, we ignored cash because we are ultimately trying to get to what the cash balance is, so we don't take the change in cash to calculate the statement of cash flows. That's it for the statement of cash flows example. If you have any questions, please let me know.